I don't think it would be too controversial to assert that it's the primary job of the investment committees at institutions and family offices to, when they meet every month or every quarter, decide on an optimal asset allocation. And I also don't think it would be particularly controversial to suggest that the equation that Markowitz described in 1967, which we call modern portfolio theory, is the dominant mechanism to create that. We have to, in order to create an asset allocation, an optimal asset allocation, there are three inputs. We need to have an expected return, an expected volatility, and correlation estimates across the asset classes under consideration. It turns out that through our research, and in fact it's more and more being confirmed by the academic research, that volatility is by far the easiest to forecast. Today's volatility is likely to be very close to tomorrow's volatility. This month's volatility is likely to be very close to next month's volatility. I just read a paper this morning that this month's volatility explains 58% of next month's volatility for US equity markets. So in answering the question, how do you control for volatility, I would answer it explicitly. Measure the volatility on a rolling basis and use that as an estimate for what the volatility is going to be between now and your next asset allocation meeting. And we do this on a weekly basis. We measure the volatility daily, and every week we observe whether or not the volatility or the correlations have exceeded a certain threshold, and we alter the allocations between asset classes accordingly to bring it back to an optimal framework. And at the portfolio level, so you're measuring the correlation of volatility at the individual asset class level, and then at the portfolio level, there's a mountain of research that indicates that by setting a target volatility for the portfolio, and if the portfolio volatility exceeds that target volatility, you lower exposure to asset classes in general with the remainder in cash. And if the volatility is below your target, then you add exposure. And in certain extremely stable market environments, those who are able to can add a certain amount of leverage to reach your volatility target. Clearly we're in a period of, in developed markets, the dominant concern among institutions is that we've been in a low return, high volatility market for the past 10 years. Japan was in a low return, high volatility market for, well, now 22 years. And so how do you harvest returns in this type of environment? Well, by managing volatility, just for an example, we've got a published study on this, but for example, on a Japanese equity and bond portfolio, just a balanced 50-50 portfolio going back to 1994, the market in Japan annualized returns a negative 4% a year. But by managing the volatility allocation between stocks and bonds, you're able to achieve a 4% annualized return and never have a peak to trough drawdown of greater than 14%. So by managing volatility at the individual security level and at the portfolio level, you give your portfolio a huge tailwind which can attenuate the impact of this sort of low return, high volatility